Okay, moving into our last half an hour with my last live guest is Nomi Prins.
Hello?
Nomi?
Hey, how are you?
Hi, good. Thanks so much for joining me on Organic News on Awake Radio.
Thank you so much.
Let me see. So you're the author of 6 books, including All the President's Bankers, The Hidden Alliances That Drive American Power, which I have and I read most of. You just wrote a piece, Democracy of the Billionaires, the most expensive election ever is a billionaire's playground, except for Bernie Sanders.
Yes.
And yeah, there's a bit of breakdown in this email that I get from the Institute for Public Accuracy, which I'm highly grateful for. So it sounds like you're for Bernie Sanders.
Well, yes, on a personal level, but in terms of the tenor of what our democracy has become and the extent to which the money in this election has made it and is continuing and will continue to make it the most expensive election ever because of the fact that without Bernie Sanders, if you put him aside, every other candidate requires their own set of billionaires to really survive, or in the case of Donald Trump, actually is a billionaire.
Right. And so you even said exactly, like, you don't need to, the corporations don't need to buy the politicians, like now they can just run for president themselves, like Donald Trump is doing.
Exactly, and of course, we have had billionaire candidates before. Ross Perot at one point, Stephen Forbes ran back in the day. But the difference now, and why this election is the most expensive and controlled at the level of the billionaires, is also there's billions of dollars being floated about for the media covering this as well. It's become a kind of circus where the billionaires, in terms of their super PAC contributions, have already contributed extensively, but it isn't over. Of course, some of them will lose their bets on their favorite candidates. One example of that is Jeb Bush, of course, who has made some billionaires very unhappy with his steady decline in his contendancy to the presidency, which is not going to happen. But you also have the billionaires that are running up behind Ted Cruz, behind Marco Rubio, Hillary Clinton, trying to determine how much they're going to continue to put in, and the fact that because of our super PAC structure now after the Citizens United 2010 decision, a lot of this money can continue to funnel in. There's no actual limit to the contributions, nor to the number of super PACs really that can be for any particular candidate. And even though there's this faux distinction that says, well, the super PACs are for issues that the candidate supports, the reality is they are another place where the relationships between sort of the more elite in the country can be connected to the elite politicians that are running for office. And if they don't get into the presidency, then they're certainly involved in other realms of our political system.
I mean, don't they have enough? Don't the corporations have enough?
Well, this is the thing. We're looking at the difference between the corporations and
bankers,
individuals. Well, yeah, and the corporations, of course, give money under the individuals within corporations can donate on an individual basis up to $2,700 per person. But of course, when you take it out to the super PAC side, you can donate $1 million here, another $1 million there. You can aggregate donors. The case, for example, just going back to Jeb Bush for a second, of Greenberg, who was the AIG's former CEO, who isn't actually giving his own money and didn't give his own money to Jeb Bush, but aggregated some other money within the company, within his new company, to basically back Jeb Bush, and of course has been slightly upset by that particular selection. So it's not always just the individual; it can be also a small company associated to the individual. But then there's also, of course, the corporations that have lobbyists and other forms of money that also come into play in terms of supporting the candidate, and don't do it for free, do it with the expectation that after that, there will be, an actual kickback, a tax break, a policy change, a face-to-face, and whatever have you. And so that's where the entire system is so very, very lopsided. And because there's just more money pouring into that lopsidedness, this election has been more lopsided. Now, where that is, of course, different is, in fact, in the Bernie Sanders camp, where he has the highest. And this is important, not just because of his message, but because of what it says about voters, is that he does have the highest percentage of small individual contributions toward his campaign. And that's not just a stat to be sort of thrown out randomly. That's a stat that actually signifies what, if there is campaign money to be put into an election, means it's most connected to the individuals and the most number of individuals that can benefit from their choice in that candidate, and how they perceive that benefit can come from their candidate. And that is actually more of a democracy than the idea that someone can kick in $50 million or $10 million or whatever have you to a cruise super PAC or so forth, and then receive benefits in return for that.
I mean, it is pretty crazy. I believe that corporations and banks can even be allowed to just buy presidents.
Yeah, and it's not even. We should not let these presidents off the hook. This is a collaboration. If you take a look, and I've mentioned some other names here, but take a look at Hillary Clinton's associations and Bill Clinton's associations over the last several decades. Basically, in more recent years, Hillary Clinton has booked almost $3 million worth of fees from just 12 speeches to the financial community. Now, if you're making $253 or whatever it is per speech, you're not basically going to turn around if you get in office and cut off all the fingers and all the hands of those that fed you. That's just not how the implicit or the explicit by evidence after the fact in the political financial establishment truly works. And so, we have this system where on a legal basis, because of Citizens United, you have these super PACs that can collect an unlimited amount of funds, basically, and also multiply and have an unlimited, effectively, number of super PACs if that's the case. Although they do fight with each other, and there have been campaigns where one will sort of merge into the other. Ted Cruz again has had several different super PACs that sort of all merge into the Keeping Your Promise super PAC collection, but each of them are sort of financed by different billionaires. So, there's a pick and choose method of this. But there's also speeches, there's also relationships, there's also decades of connections and associations that establish a certain philosophy of governing, a certain philosophy of deregulation, of tax breaks for companies, of offshore abilities to take money away from the revenues that would go into the government and be used for the population. So there's many different ways of which people and companies and sort of the big money relationships are collaborations with many of the politicians and certainly all of the past presidents, and that's what I discussed in my last book, All the President's Bankers, that have always been there, that have always had a relationship and money-related impact and collaboration between whichever party president was in power and whichever very elite, whether they were bankers or other corporate heads or billionaires, were involved in that political process.
And you had written that Hillary Clinton claims that her Wall Street plan is stricter than Bernie Sanders, but which it actually is not. That he's advocating to break up the banks, by way of a 21st century version of the Glass-Steagall, that when Hillary Clinton was actually confronted by someone asking her if she was going to reinstate Glass-Steagall, and they were removed from the venue.
Right, there's democracy for you, but that very that is just one of so many examples of how those relationships and those, through money, through, sort of hierarchy, through establishment, close ranks on anyone who questions them from the outside, and why Hillary Clinton, if she were to become president, would not, of course, obviously break up the banks, because she's been very clear on that. But the other problem with her policy is that by saying it is stronger than Bernie Sanders, it also perpetuates a false notion onto people who don't understand why it's not stronger than Bernie Sanders. Not everybody in the country, because, we all have lives and different, sort of things that are going on and interests and so forth, is thinking about what Glass-Steagall means to, for example, the amount of, money they pay at an ATM to get their cash out. And people aren't making that distinction on a regular basis. They're going about their lives most of the time. The Glass-Steagall Act was something that was, created in 1933 in the wake of the Great Crash in 1929 and the many years of depression that followed. And it was an act that was created by Republicans and Democrats. It was an act passed by a Democratic president, FDR, but it was also happened to have been an act pushed for by Republican bankers. And in fact, Winthrop Aldrich, who was the head of Chase Bank at the time, which today we know of as J.P. Morgan Chase, took out a front page article in the New York Times to push for Glass-Steagall to separate the activities in banks from those that focused on individuals, on their deposits, on their mortgage loans, on their savings accounts, and those that were more speculative in nature, that were creating securities and trading and betting in the open markets. And the idea was to distinguish these two in two separate types of companies. And it was something that even big bankers at the time were advocating. And this guy was a Republican, Aldrich. His father actually was one of the men who had been a senator who had fashioned the Federal Reserve. So there was also some strong political ties there. And he actually was asked by FDR to help make the Glass-Steagall Act even stronger and stricter than the original language of that act under Carter Glass would have been. So now we have, fast forward, a situation where we have a Democratic presidential candidate under Hillary Clinton, whose husband, Bill Clinton, was the president when the Glass-Steagall Act was repealed in 1999. And at the time, Bernie Sanders voted against having that act repealed in 1999, saying that she has a stronger plan to restrict the ability of Wall Street to mix people's deposits with their speculative trading. And that's just simply not only not true, as I mentioned in the piece, it's not even fathomable to be considered to be true.
A couple of months ago, Timothy Geithner and Ben Bernanke gave a talk at the Union Square Barnes & Noble on Ben Bernanke's new book, The Courage to Act. And, they took questions from the audience, and someone asked them one of the questions that was read, and they answered the question of, and I want you to hear what Ben Bernanke, what he says.
Poster child, I don't quite understand.
What's your favorite villains?
Well, there's issues with the and so on. But I'm some of the rules were more friendly and things of that sort. But on Glass-Steagall did basically was saying you couldn't have regular commercial banking making loans to consumers, for example, and investment banking, which is issuing new stocks and bonds. You couldn't have those two activities in the same firm. But if you look at the crisis, most of the firms that got into trouble were either investment banks or commercial banks. Investment banks like Lehman Brothers or Bear Stearns that got into trouble with their investments. Commercial banks like Wachovia, Wagoo, and others that made bad loans. So Glass-Steagall, if they would have prevented them from being the same company, but it obviously didn't have much to do with the fact that they got in trouble and they helped bring down the system. So I don't think that's really the key element of the problem. I think the basic problems have to do with funding, with complexity, and with too big to fail. And those are some of the things that have been tried to address, not completely successfully, but certainly in the right direction.
Were you able to make out what he said, Nomi?
Yes, and I know what he said because he said it before, and this is the party line of Ben Bernanke, of Tim Geithner, of Hank Paulson, who was Treasury Secretary before Tim Geithner, and all these people on opposite sides of the political spectrum who are perpetuating, as are some of the people in part of the media, that somehow it is these investment banks, because they failed, had nothing to do with Glass-Steagall being repealed, because investment banks are not commercial banks. And the reality is, and this makes me so, I've written 3 books on this, even before they started, messing around with the historical nature of what banks are with respect to their party line to the public. And the thing is this, to break it down in, a couple minutes here, because it's really important to understand that, first of all, commercial banks or commercial investment bank conglomerates, such as Citigroup, such as JP Morgan Chase, such as ultimately Goldman Sachs and Morgan Stanley, which were investment banks, which were allowed to become commercial banks in their name so that they could receive bailout money from the government. So talk about switching over lines with no specific legislative authority, just a Federal Reserve and Treasury Secretary agreement. Those banks operated by funneling funds into the investment banks that bought the securities that they were creating off the mortgages that they were sourcing and concocting into complex securities. Without both of those players, without the ability of commercial banks to source mortgages, to combine them into securities. Okay, so those 2 things, issuing and buying and selling mortgages, creating securities out of them, that would have been illegal under the Glass-Steagall environment. Glass-Steagall's repealed, it's now legal. Okay, so now we have all these subprime loans being scooped up by the bigger banks because they have more of the money. And they acquired different banks. They financed some of the smaller companies that were issuing mortgages. They were involved in all sorts of different aspects of the mortgage creation process, the part that touches humans. And they were also involved in the part of the process that created from these mortgages a lot of complex, esoteric securities and derivative securities. That would not have happened under Glass-Steagall.
Right.
Because that happened, Lehman Brothers and Bear Stearns were part of the financial community, were able to both borrow funds from these banks, because that's how the credit lines work. There are some very specific evidence of the example where JP Morgan cut off its credit line to Lehman Brothers when Lehman Brothers was failing. It would have not been able to cut off the credit line if the credit line didn't exist. The reason the credit line existed was because Lehman Brothers was one of the companies that bought some of the esoteric securities that JP Morgan and others like it were creating. So the fact that these people, and Hillary Clinton has now become one of them, but Ben Bernanke, Tim Geithner, Hank Paulson are perpetuating this concept, as is Andrew Ross Sorkin at the New York Times and others, that somehow Glass-Steagall did not allow an environment in which this happens is completely erroneous. It does not examine the actual flow of capital or cash or securities or who was borrowing money from which other institution to do what they did in bulking up the subprime crisis. And then ultimately, yes, the banks that failed were investment banks, but they were funded by commercial banks, and the entire exchange of mortgages versus securities and complex securities created from mortgages could not have happened in a Glass-Steagall environment. It's really that simple. And so this idea of segmenting off these failed banks like Lehman Brothers and Bear Stearns, and by the way, I worked at both of those companies. Not that I'm just saying that in terms of I know how credit lines work at these institutions. And I worked at Lehman Brothers before Glass-Steagall was repealed and Bear Stearns after Glass-Steagall was repealed. And I can tell you that when money was available to these institutions and when complex securities were created for mortgages or other things by the conglomerate banks, they both impacted the risk that was in the markets. They both took the market down. Some failed, some were bailed out by the government. That is true. But with a Glass-Steagall, with a full Glass-Steagall restriction, the entire scenario would not have occurred.
Right. I mean, because it never happened while Glass-Steagall was in place.
It couldn't happen.
Right.
And part of it's because the market got more complex. But yes, you are exactly right. And by someone like Ben Bernanke being able, with his gravitas and his position and his book, and having obviously wanting to save his legacy, or I shouldn't say, he has his legacy. They would perpetuate the elements of his legacy that are not quite the truth. That kicking the idea of Glass-Steagall coming back enables them to say that, well, now we have the problem solved. Now these bad investment banks are out of the way. The good banks that we, by the way, bailed out and subsidized and still have zero interest rate money from the Federal Reserve that are continuing to be alive and kicking and continue to be under investigation for all sorts of frauds still related to that entire situation, in addition to the money that they've already paid for the frauds that they have settled upon, that somehow the system is more intact and that we don't need to, therefore, re-examine the idea of breaking up these banks. And that's just purely wrong.
And the banks have to be even that much more bold now that they got bailed out, from that crash of 2008. I mean, they just must be like, wow, like, look what we can get away with.
Well, exactly right. And plus, because interest rates are at zero, what the banks are now doing is actually more complicated. Because in order to make more money when rates are lower, you take more risk. That happened in the subprime crisis. One of the reasons subprime loans were even issued was because rates were generally low and banks were looking for ways to make more money off of charging more people higher rates. But also, and that was not what caused the crisis. What caused the crisis was the fact that securities and derivatives and all sorts of things were piled on top of those mortgages. Had just those mortgages gone bad, we would have not gone into the hole that we found ourselves in. So that's number one. And number two, so now, as you said, there are more risks being taken by these banks, but because they have been bailed out, because they are bigger than they were before the crisis, they also are in a situation where they have more cheap funds to do what they do with and less competition.
Right. We only have like 5.5 more minutes left, but I often hear you use the term cheap money in describing quantitative easing. Can you just describe what you mean by that?
Yeah, I mean that we have been for the last 7 years, and the Federal Reserve did raise interest rates a teeny bit in December, but basically we have been in a 7-year period where the federal funds rate has been at 0%, which means that banks can basically borrow funds at no money, which means that if they are required to lend to, say, companies, which has happened, more issuance, more loans have been made to larger companies who in turn have used that money to, for example, buy their stocks, which have elevated the stock market and had all sorts of other impacts. This cheap money comes into the system originally from the Fed to the banks and then goes and creates all of these bubbles, whether they are in more issuance of bonds, of debt, whether they are in elevating the stock market for purposes other than companies producing more or expanding more in terms of research or hiring more people or paying people more, but just in terms of having that money flow through the company into the stock market. And that's what I mean by cheap. You're not earning the money.
Right.
This isn't money coming from profit. It's not money coming from returns on actual investments in real things. It is money that is coming in at the base level of the financial system that is basically fabricated by the Federal Reserve and other central banks. Central banks meaning the banks that are supposedly in charge of what they call monetary policy or the setting of the cost of money, which right now is cheap or zero, depending upon which country you're in. And that's what I mean, that you have this artificial source of funds, and that creates risk. It's like if I said to you, I'm just gonna, I will loan you money at nothing, like forever. You could get a little, prone to taking some risks if you know that you're going to be getting money from me at no interest rate forever.
Right, no consequences.
Right.
Would you call that money counterfeit?
It's artificial. It's fabricated, is what I call it.
Yeah.
It's not counterfeit in that it's officially part of the financial system. Treasury debt is officially created by the Treasury Department, the Federal Reserve, through part of its policy called quantitative easing, which has helped keep rates at zero, buys that debt. Banks reserve money at the Federal Reserve by effectively pledging the debt they buy from the Treasury Department to the Federal Reserve. There's a triangle of real fabricated money between the Federal Reserve and the private banks, and then where the money is real is where we owe it, and that is in the debt that the Treasury Department basically has created, or the money it has loaned, is borrowed effectively from the future or from other countries to subsidize this financial system.
Right. I mean, so, I'm just trying to drive the point home, because a lot of people think that the Treasury creates the money. We used to try to, when we were down at Occupy, with Danny Schechter, the late Danny Schechter, just trying to educate people about the Fed and that it's a private bank. People were calling it a for-profit bank.
Well, it is a for-profit bank in that it does have a budget. It does make it does seek to make money, and its members are by proportion the larger banks. So, for example, the New York Fed has a collection of member banks that have shares. And ultimately, all the shares of the larger banks have a higher proportion of ownership in the Federal Reserve System than say, the smaller banks. And just like we were talking about with billionaires, so that gives them certain rights to policy, and it gives them certain rights over how the Federal Reserve will be allocating their money or the rate that they will charge for their money, even though the official status is that the Federal Reserve is independent. It's independent of policy, it's independent of the private sector. But the reality is that the private sector do have shares that they hold in the Federal Reserve System.
Again, we're a bit out of time. I wish that that we had more time, because I do have a couple of more questions. But so again, just in closing, Bernie Sanders has stuck to his word, running a campaign with no billionaires.
Right.
He's raised an impressive $41.5 million and spent about $14.5 million of it. None of his top corporate donors are Wall Street banks.
Right, and actually he's raised more than that. That was through the last quarter. If we will include the last quarter results, the figure is closer to $75 million. And yes, not with any of his top corporate donors being Wall Street banks, and the numbers will change with the new allocations, but a good 75-77% of his donors being individual small donations, and having more contributions, more people contributing to his campaign individually than any candidate ever, including outpacing Obama's candidacy in 2012.
And one last comment I wanted to make, because you were talking about how it's become theater, this whole campaign with all of the money that is flooding these candidates, except for Bernie Sanders. And I believe that when he speaks, you can hear it coming from him, that he is free to say certain things. It's
a very nice feeling. I mean, it's a nice thing to hear, and I'm sure it's a nice feeling that none of the other individuals in this campaign can have authentically. Trump in a sort of weird way, it's his own billions, I suppose, but But even that has been on the backs of a lot of sort of different deals, whereas in the Sanders campaign, what he has for the most part are a solid foundation of individual contributions, of which, again, most of them are from small donations.
So I hope to have you back on again, Nomi Prins, who wrote All the President's Bankers.
Thank you so much.
Take care, Nomi.
Thank you. You too.
Okay, bye.
Bye.
Okay, so that wraps it up. Please go to Awake Radio 1 on YouTube. Please support organic news and help keep alternative news no corporate funding with organic news. So just like Bernie, we need the people's support. Thank you. Good night.